It's Thursday, February 3rd, 2022, and today we're talking about accelerating growth via acquisition. Daylight Automation acquires Proof Data Technology. 3 large funding announcements, all with similar timing. Coincidence? Hopper is taking on Airbnb to increase revenue and improve unit economics. And Blackberry is going to be having the time of their life. All right, let's get started. Alex, first, we're talking about accelerating growth via acquisition. Daylight Automation acquires Proof Data Technology here. What is going on?
Well, you explain what's going on. And so instead of me trying to explain what this means, I have a special treat. We have one of the co-founders of Daylight here to speak about the acquisition. Can we bring Art to the stage?
Hey, how's it going?
Hey, Art. Good. How are you?
Doing great.
Whereabouts are you today?
I'm in Toronto, just at home as I have been for a couple of years.
I know that feeling. Good thing is kids are in school, so we won't get interrupted today.
That's right.
So maybe let's start off with the basics. For people that don't know Daylight, can you explain what you guys do?
Yeah. Daylight we're a platform we're really aimed at helping organizations unlock their digitization and automation strategies and potential so that they can create the ideal experience for any interaction that they have, whether it's employee or customer driven.
Excellent. So that basically sounds like you make enterprises have better customer experiences.
Yeah, you kind of think about it as the quick tax for any experience, or the turbo tax for any experience that you're going to have at a bank, at an insurance company, with the government, or a lot of those that they struggle to be modern and guided, and we're there to enable them to be able to build rapidly ideal experiences.
I love it. So now you acquired Proof. So what did Proof do?
So Proof was, they were really focused on the government space, and they were helping track approvals and route paperwork digitally across departments. And what's really interesting is they were actually a customer of ours really early on, and a partner of ours. So we got to know the founding members, Wes and Ben, who I know you've had on the show. And we got to know their team, and they were leveraging the Daylight platform to further their mission of improving the way that government operated. So we saw we had a real kindred spirit in making processes better.
So I love that. Like, tell me a bit more about that relationship. How do they become a customer of yours? How long ago was that? And how closely did the teams work together?
So the exact date, I'm not sure. We were probably about 2018. We were in 111, part of the Toronto, startup and scale up ecosystem. And so a lot of us are looking at what's our core and how can we extend our capabilities through partnerships and relationships. So we met them as they were scaling up, and they were looking to implement custom solutions for their different prototypes and customers. And we worked really closely because they were pushing the boundaries of our platform. I had a text relationship with Wes while he was, whether good and bad, as they were doing stuff around COVID for the Yukon and other areas. And what they were doing was really impressive to us. It was really driving value. We had to, always work in that startup-y way around what the economics and how we could make it work for each other. But we got to know how amazing their whole team was and their culture. And we saw the opportunity to really further our mission to do this across industry and into the US. And we took that opportunity to bring them in-house.
So I love that. So tell me a bit more about how that opportunity came together and what the logic was. Why did you get excited about this deal?
Yeah, well, I'd say back in September, we announced our Series A raise with Golden, RTP, and Bessemer Venture Partners. So that was really premised around our growth, replicating the success we had with banks, insurance companies, and others in Canada, but bringing that into the US. And as you know, talent is such a difficult thing, and the talent to lead solution engineering, business development, and hit the ground running, and to keep the momentum we have. So we were talking with them, and it was just the right time for their business. And we were in such a need of the skill sets that they had. So it was kind of an ongoing conversation. It was opportunistic. We weren't out looking to acquire, but the opportunity presented itself, and we couldn't be happier with the outcome.
It sounds like you love the team. So what's the team going to do post? Like you got Ben, you got Wes, you got a few other members. Are they going to be running a government focused unit, or what are they going to be doing post acquisition?
So really, it's about taking their knowledge. Obviously, they can help further our mission within government entities. We're really excited about the knowledge and the relationships they have there. But it's actually about broadening and bringing both the technical people. While we're not necessarily utilizing their existing technology, they've done the research, the work, they've done the thinking about some of the features that were already on our roadmap. So we're excited about bringing that in house. And for Ben, Wes, Manu, other people across the team, it's giving them the opportunity to use the lessons they learned in government, which obviously is a painful experience across the board. But it's the same value that you can bring to almost any large organization. So you kind of have them broadly deployed to help the end-to-end growth of Daylight. And it's they're only about a month in for the longest tenured people. And it's unbelievable already to see how they can add value so quickly.
I love to hear how you've filled a gap, or you've accelerated your team by getting right talent and a right mindset. One question for like founders that are looking at this acquisition and saying, okay, sounds like Art was super excited. He knew Ben. So like, did you just put a term sheet? Like, how did you get approval for this? What does a deal like this need to happen? Like, is it just founders can, you've got investors. Do you just go to the investors, say, hey, let's do this, or just don't have to do the details? But what does a process like this look like?
It's like everything else being a founder, not everything else being a founder, and in transparency, a first-time founder, you didn't wake up in the morning and say, I'm going to acquire someone today. So some of it is stumbling your way through it and talking to your board, in our case, talking to the proof investors. But really it was just looking back and forth and saying, how do we make it right? We're because there was an existing relationship, we wanted to make sure that we're giving them the best opportunity, making it right for the team, the investors, and trying to do it fast so that we weren't putting them in a position where it was, if they wanted to continue on the way that they were going, we didn't want to disrupt anything there. So it was a difficult dance, to be honest with you, but it really it was about finding a way that didn't impact our runway, our growth, but that also we could sell to our own investors and to ourselves that this isn't going to disrupt, this is going to accelerate. And we saw that from literally the first or second day of conversations, and then it was just crossing the T's, dotting the I's to get it done.
I love that. Now let's just go. So one of the reasons you got proof was to fill, I guess, a few holes and run faster. Do you still need more people at Daylight, or have you filled all the open roles?
No, we certainly haven't filled all the open roles. We're really excited. In the last, it's been a big change. In the last quarter, we brought on CRO, we brought on VPs of finance, CTO. So we've been really filling out our executive team over the last quarter, a little bit over our last quarter. But we have opportunities, and we're looking at people in the US. We're looking at growing really pretty much across every team. So it does not end. We're just really excited about the foundation that we have, and they were kind of rounded out the two of the more difficult roles to hire from the founding team.
So last question: if someone wants to join your team, how can they find out about the opportunities that exist?
Daylight.io. You can go to our website. You can see careers there, and we're really proud of our culture, really proud of the team. So like any other role, if you're really serious, find someone. Reach out. Our team's pretty accommodating, and I love hearing from people that take that initiative too and just want to actually chat and see if they can bring value. That's a great start to a relationship. Well,
Art, congratulations on the acquisition. I look about hearing a lot more great things from Daylight, and maybe we'll get you on to talk about more about Daylight in a future episode or another TechTO live stream. Thank you so much for your time.
Thank you so much. Thanks for having me.
Love it, Alex. Now, after conversation with Art, I'm curious, what are the main takeaways you think we've just learned here for founders in the Canadian tech ecosystem?
So I'm going to have I think the key thing here is the best early stage acquisitions are based on relationships. I think a lot of time people read about companies getting acquired, and there's two different types of acquisitions at the early stage. One is someone brokered a deal or someone purchased a deal with no past history. And those deals happen, but I believe most deals happen when there's a champion and someone that knows your company well at the acquiring company. It's, you could have met them through industry events. You could have had a partnership like this, or it could be a personal relationship. And so the best way to get a deal done is when someone knows and sees how your company can work, has a relationship, is willing to challenge it to the board, challenge it to the partners. And it's a bit counterintuitive because a lot of founders get advice that you don't want to be talking to potential acquirers, and that you may not even realize you're talking to potential acquirers. But I've had founders say, hey, this big company reached out to me. My other investors said, don't talk to him because it looks like I might want to be sold. But you know what? Maybe in 4 or 5 years
Never heard that story before, Alex. That seemed very unique.
I've seen it multiple times. But but like relationship you build now might help you, get acquired in 4 to 5 years. So I think that's the first thing. Like build relationships. You never know, what it's going to result in. Second thing, companies that want to grow rapidly need great talent. They understand, preferably great talent that understands the problem they're solving. And if we've talked about the last 6 months, it's incredibly hard to find that talent. So acquiring a company that has shared values, shared customers, has shown to be great, can have a disproportionate impact post acquisition. 1+1 = 3. And because of this, I think we're going to see more deals like this. Not like one every day, but I think in the ecosystem, it helps when two companies combine to make a stronger, faster company. So I think we're going to see more of those going forward.
Sure. And you know what? Maybe we will see one every day if we keep making more small companies and they keep building relationships. Because I think you can only do these kinds of acquisitions if there's tons of availability in the market. And I think there's a lot coming down the pipeline. So stay tuned. You know where else you should stay tuned to, Alex?
What?
The newsletter. If you want more insights on what's happening in the Canadian tech ecosystem and the future of everything that is going on in tech, you've got to subscribe to the TechTO newsletter. Alex, what is going to be in tomorrow's edition?
Well, there'll probably be a written version with more in depth of one of the quick takes. There's going to be some reading roundups, or maybe might include a blog post, a podcast. So tomorrow's we focus on highlighting news, what our analysis, and what you should read from around the web.
Amazing. You can subscribe to keep up to date with everything Alex said and more on our website at techto.org/newsletter. Next, we have 3 large funding announcements, and they're all with similar timing. Is that a coincidence, Alex?
Well, let's get into what they were. So Tuesday, you woke up and by like noon, you thought like everyone's getting $100 million or more in this ecosystem. Coho announced a $210 million round led by Eldridge Capital. League finally announced a round that BetaKit first reported about in December. They announced a $95 million USD round led by TDM Growth Partners with participation from Workday's venture fund with a valuation of $945 million USD. Mike Serby just indicated that they might raise up to $200 million in this round, so that's interesting. And then Montreal-based Renault Run announced a $142 million USD round led by Tiger Global with participation from Soza Ventures.
Very, very cool. I got to ask, what's going on here? Something in the water? Is it the phase of the moon? Like why are we getting these announcements all at once?
It seems like this was a coincidence that were all announced here. If you go to each one, Coho closed in the round about 2 weeks before, and I think, if you're closing a big round like this, you want to give yourselves a couple of weeks before you announce it, because they'll just, there's always straggling. The deal takes a bit longer to close than expected. So that was a really rapid timeline. League, I'm not sure why it was broken. Like BetaKit first announced that a round was coming together. They had the basic details right. They said it was going to be 70 million. It was valued at 350. They didn't know if it was pre or post. This looks like that was true. It looks like this was 850 pre with 70 million committed, and looks like Workday Ventures is committing 25 more million. So what BetaKit had was right, but not the full story. And according to Mike, they're still raising another 105 million. So it's a bit odd to see a round announced before it's all officially closed. So I don't know if they're trying to get a bit more momentum or what. And then Renault Run closed in the fall. So I'm not sure why I'm not sure why they picked February 1st to announce it. Maybe they're about to enter a new city in the States, or maybe they're doing a hiring spree and they want to create momentum. So we're using it for some ulterior purpose other than announce the round.
Right. But is there really an ulterior purpose that's common to these 3? Like, is there a conspiracy happening here right now on why they were all announced? Or do you think this is really just a major coincidence?
I think it's a major coincidence. I think what's more important and more interesting than the announcement is, how did each company get to be this valuable?
Right. So let's move on from this, from the VCs getting together and saying the first week of February is the week that we will announce it. And let's get into 3 common or different stories of how each company got to this point.
So maybe let's look at their stories and we can see what's common and different between them. So Coho, which we actually did a special quick takes on to announce the round, they were founded in 2015. And as we talked about that, it seemed to take a little time building momentum. They took their time building a product, getting some regulatory approval, I guess, figuring to go to market and accelerate. And since 2019, they've accelerated. They're now 500,000 users. And they've raised most of their money since 2019. And this slow and steady growth has led to hundreds of $1 million valuation. And that just back of the envelope, not knowing the valuation, but it looks like they're worth about $1,000 per user. Then you have League, which started 8 years ago. Mike Sarabinis already had 2 large exits, so he had easy time raising. He's taking on the healthcare industry, and he's pivoted a few times to find what he says is now finally product market fit. They're now a platform company that allows pharmacies and insurers to offer healthcare services to customers. They had $35 million, about 35 million USD revenue last year. They have 1 million users through software. That now they're expecting $100 million revenue this year and 10 million users end of year. So you see a story here of an established founder taking on a big market who has pivoted several times, but has a backing of Canadian venture capital ecosystem and corporate Canada to earn that, give them the right to play around until he gets to something that can scale. Yep. Interesting here. If you look, they're valued at 24 times trailing revenue, 8.5 times proposed revenue, and roughly $1,000 per user. Finally, you have Rent-A-Run, which is the newest one of them all. They were founded in 2017 and the founders were inspired by Instacart. So, but unlike Instacart, who are helping incumbents, these guys have vertically integrated and compete with Home Depot and Lowe's. Their round was led by more, let's call it, traditional US VCs, with Tiger Global, Sozo Ventures, Fifth Wall, Triple Point Capital, Scale Up Ventures, Inovia, and Real Ventures all participating. The company generated roughly 30 million plus annual revenue last year. Had 15,000 contractors, targeting 100 million revenue this year. As they expand to 10 North American cities, the round is looks like it was 24 times last year's revenue and 7 times this year's projected revenue, and they're worth about $50,000 per contractor. So now that's a lot. Maybe I should break down to why I see common. Do you have any takeaways before I get into this?
Is there going to be something about the $1,000 per customer here? Is there some magic number?
Maybe. So the first thing is they're all addressing huge markets. Look, construction, healthcare, and consumer finance. You're not talking about a small market. These are established markets. They have surprisingly similar valuation metrics of 1,000 per consumer. The 7 to 8 times future revenue. They have all a significant install base that they can cross-sell into. Koho can introduce more products to its consumers. League offers more services. Rent-A-Run's using the money to expand from 20,000 SKUs to 100,000 SKUs. So they have all established a big customer base that they can get more revenue out of. And they're all using funds to expand distribution. Koho is going to acquire more consumers via marketing. League is onboarding more partners. Rent-A-Run's expanding to new markets. What's not the same as a path to success. How easy it was to originally raise money, how long it took them to get there. And each has a different business model with different margins. So there's a lot that's similar, but the fundamental businesses are different, but lots of, big market, big installed base, still expanding the consumer base.
What's the lesson that an emerging entrepreneur or founder that's listening can take away from this?
Well, first of all, this is a reminder that funding announcements have no correlation between the timing of a round actually closing. And that as an early stage founder, you might, lots more time. I just closed around. Let me go make the announcement. But my feeling, all 3 of these have made an announcement to get attention to something else. It could be used to, hey, show employees we're a hot company, come work for us. It could be saying, hey, we're going, like Rent-A-Run maybe opening up in 3 markets this week. And so it could be, let's say they're opening in Chicago. It's pretty good to say, hey, here's a new company entering the market. They just raised $140 million. Use around, the one time you'll get attention from reporters is when you've announced a round. So use it to get attention and use it strategically. The way to become scale is to identify a large problem that you can solve 10 times better. Koho makes consumer banking transparent and affordable. League provides a better experience for customers. Rent-A-Run saves times for contractors on getting supplies. Like if you read about Rent-A-Run, so contractors will go as often as once every couple of days to a Home Depot and Lowe's, and it costs them productive time and time for employees. So, gets back to basics. Solve a big problem and do it 10 times better than anyone else. Easy said.
Interesting. Yeah, that's right. That's right. Ah, finally, the same advice we give every week, but maybe in a new way. Hey, that's why you tune into Quick Takes. I love it. You know what
Hey, there
else you
was a
might
new
want
one
to?
about using your funding rounds for other purposes.
How much content on the internet is exactly the same things, but packaged in a way that we just might reach you today and change the course of your business. All right, I'll tell you what else might change the course of your business. It's a TechTO live stream, and we're going to be bringing back our Canadian rocket ship list for 2022. What are the hot companies that you think Canadians need to be watching this year? Make sure you're following our newsletter for more details on how you can nominate or get involved and have your favorite companies featured as Canadian rocket ships.
So, Jason, one thing here, this will be a new list and it'll be improved because we got a lot of feedback on what the formula we should use to identify them. So, this is going to be more of a community effort to identify the companies we may have missed last year or the companies that have emerged since last year.
I love that. That is exciting. You're pumped?
Oh, I'm excited.
Are there going to be some special guests?
Well, of course. What would life be without special guests?
All right. Next topic for today's show. Hopper is taking on Airbnb to increase revenue and improve unit economics. This is awesome. I love the story of, I don't want to say the little guy, but the emerging leader taking on the category leader. What's going on here, Alex?
So Globe Mail reported that Hopper is building a short-term home rental offering for its app. Basically saying, hey, they identified that this is a missing product we should add for our consumers.
And why? Like the Hopper's doing great. I don't want to compete against the guys from Airbnb. Like, what's the point of launching this product?
Well, it's interesting because in that article, Hopper mentioned that they sold $1 billion worth of hotel rooms per year, and they believe that half of accommodation revenue comes from alternative accommodation, short-term rentals, e.g., Airbnb and VRBO. So that by adding a short-term rental option, they will double their hotel revenue by another $1 billion.
Now, today, does Hopper already search alternative accommodation sites like Airbnb? Are they starting to compete with one of their suppliers?
So they don't sell Airbnb. I don't think Airbnb distributes to other people. And so this is a new initiative. They've gone and recruited a bunch of let's say, corporate short-term rental places to launch a product, and they call it their MVP. But it is a competing product, and they're saying they're going to be more transparent on pricing. It's going to have better features. It's going to use stuff Hopper's, is known for. Like probably, my guess, it'll be some financial products like you can cancel last minute or pay for insurance. And if they have a surprisingly large installed base that they can compete, they have a distribution of, according to Apptopia, they're asking downloaded 70 million times.
Okay, that's a lot of times. So those are good reasons why this makes sense for Hopper. Is there anything else that you think there's are there any other reasons they should be doing this?
Well, this goes back to what we were discussing before. They, with these three large announcements, they have they're a late stage company or later stage company. There's a growth stage, let's call it. So I want to get this right. They have a large installed base and they need to keep on growing. So what they're going to do is take advantage of distribution. If let's say there's 70 million app downloads, I don't know how many customers that is. My guess to get more app downloads is relatively expensive. So by adding, this is a relatively low risk move. They're gonna, I don't know what they have to, let's say they're targeting $1 billion in extra, sales. I don't know what their break even is, but my guess is it's pretty low. And if it works, what have they done? They've increased their revenue growth rate because they've now added another $1 billion of, I don't know what the margin was, but they've got $1 billion more sales. They've increased customer loyalty because that customer that didn't want to go to the hotel might go to Airbnb. Now they have one less reason to leave the Hopper app. And they increase the lifetime value of those customers because they're not generating more revenue, which allows them to go spend more money to acquire new customers because they can justify it because they want to, so you've got a pretty no risk move. Maybe it doesn't work, but if it works, faster growth, more customer loyalty, better lifetime value. And if I look at them, I imagine they've looked and said, what is the opportunity cost for the dev team? Is there something more, that we should be high priority? So my guess is this is pretty high upside, low downside.
I agree. I'll add one more thing, which There's nothing that builds your tribe or your culture or your company's mission like trying to take down the fancy pants category leader. It unites us versus them. And I think giving the team something big to shoot for, like unseating Airbnb at their own game, I think brings people together and gives them a big goal to unite and go after. So I think that's exciting. I think that is really exciting.
I love that. That's a good takeaway for motivating your employees.
Totally. Do you think that's one founder takeaway? What else do you think founders can implement here?
Well, go back to advice that you hear often, or sayings you hear often. Many startups think their innovation is going to win, but if you talk to investors, they're always asking, will the startup gain distribution, or will the incumbent innovate first? And so that's one of the reasons why you hear someone like, oh, what if Google does this? Or what if Amazon does this? You may have a great idea, but if you at the beginning, it's proving that idea works and getting distribution and customers. And if that idea can be just planted onto someone that has that distribution already, it's hard for you to win. So sometimes it's good to understand why or why not an incumbent would choose to basically copy you. And I think this is another reason why you may see some early stage companies quickly raise money and gain customers despite having odd or not great unit economics per customer, because they believe owning that customer relationship will allow them to monetize it via new and more products that are adjacent and improve economics over time. Don't know if it works, but that's one rationale people give.
I love it. I think they're both related. The way I think about it is, I think when you're getting started out, you're right that big tech can introduce a feature that's your whole company, because you do start as a feature. And I think what we've seen from companies like Hopper that make it to the top of the top is that they continue to add new features onto it, which actually creates a product or a company versus just a feature and then a product. And now you have a whole portfolio of different products that are a lot more defensible than any one feature. It's now impossible for big tech to roll out a Hopper feature because there's so many things that are on it. And I think at the beginning, don't get discouraged. You will be a feature. Just a small feature that anyone can knock off. But as you get smarter, as you get bigger, as you get more funding and customers, you can expand on that and become a whole company. I'd like to become a whole company one day. Doesn't that sound
yourself?
Actually, I want every insider to become a whole company. So if you want to join a community of other folks in Canada that are looking to go from feature to product to company, you got to check out the TechTO.org Insider Membership Program. Alex and I are there every single day answering questions, making connections, and helping grow this community. Is there someone that you've been hanging out with from the Insider community recently, Alex?
Yeah, I think I can't remember the exact name, but it's Grace from BDC. We've been talking about alternative ways of financing your startup.
Very cool. And this is kind of neat. Tomorrow, a insider reached out to me and said, hey, we should go grab a coffee. And now it is going to be a TechTO coffee happening tomorrow at 10 a.m. I think we've already got a dozen folks who will be there. So if you want to get out of your house, come to a coffee shop newly opened in the province of Ontario and hang out with like-minded technologists. You got to become an insider and get on that invite today. Cool. And then a final quick take. We said Blackberry is having the time of its life by letting go of the past and selling their patents of the legacy smartphone business for $600 million. Now, there is a lot of Canadiana tied up in this patent package. There's a whole country's pride and ego in there. Why is BlackBerry letting go?
Well, they want to focus on basically cybersecurity and connected cars. And so they said, okay, let's monetize these patents from our legacy business and sell to a U.S. firm that plans to use licenses. So I guess, I don't know if it's a patent troll or they're going to find ways to license it, but $600 million is a lot of capital to do what you need to do for your next phase of business. Now, Ottawa's not happy. They're reviewing this to see if the sale should go through.
I love that Canada still thinks that there's some proprietary edge in the BlackBerry patents from 20 years ago.
It's all on the BlackBerry Messenger.
Yeah, that's right. Hopefully the security components are the ones that they're keeping and the encryption components are the ones that they're holding on to. But yeah, maybe we'll see a bunch of knockoff smartphones coming back with physical keyboards. I mean, who knows? Okay, why,
Maybe.
if you're a founder in this community, why do you care about this patent package being sold?
Well, first of all, just for myself, I just, nostalgic about BlackBerry, so it's good to see them trying to clear up the balance sheet. And it makes it clear no longer phone business. If you had any doubt, like my father's like asking me, should I invest in BlackBerry? I hear they have a new phone coming. It ain't happening. I actually think there's a couple things here. One is founders, we had a TechTO live stream about IP. And I think founders usually undervalue IP. And as you scale, there's reasons to protect it and package it. Like we joke about, like, there's probably stuff around security, there's probably stuff around how, phones communicate with the keyboard. I don't know what it is, but IP can be valuable, right? So look, this got $600 million for a bunch of patents. And again, it was a lot of them, but that's a better outcome than most companies have. Second of all, when you change your business, there's nothing better than get rid of everything legacy and get the capital to focus on new business. Like I think a lot of founders do that pivot, but they're too scared to close down their old customers. It's too clear to cut the cord. Took BlackBerry several years, but they've now cut the cord. And finally, I have IPs becoming valuable. There's a bunch of people saying, "Oh, we shouldn't sell IP because it comes from our government, comes from our capital talent. It's like selling our forests or water." Yeah, so you're seeing a lot more IP protection by countries out there. My question is here: would Ottawa be looking at this if it was not a former tech giant? If it was like with a vocal founder behind it, like if it was, I don't know, so how about trying to sell their IP patents? Would we have the same attitude?
I don't think so. And I think those takeaways are awesome. Commit to that pivot, even if you don't get 600 million in the door. Get rid of your legacy, change your mindset, and commit to the future, whether it's connected cars or whatever else you're trying to build. Thank you, Alex. Holy cow, what a week in Canadian tech. This was one for the record books, folks. And if you haven't already, you got to like and subscribe to TechTO wherever you're watching or listening, and we'll see you on the inside.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be in the next multi-billion-dollar idea.
So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.